Yeah. Welcome back to Infinite Investors. Today's Saturday. I'm Curtis. Must mean another portfolio update. I'm going to talk about one dividend payment that I've received this week. I'm going to talk about the top movers and fallers within my portfolio and give a reason why I believe they've moved and falled this week. I'm going to talk about earnings and why I think earnings is a great buying opportunity. And I'm going to also look at some historical data to kind of reinforce that message. Lastly, I'm going to talk about whether or not we are in a dot-com crash. Is this tech bubble 2.0? Should you be concerned with the valuations of stocks at the moment? And I'm going to give you a quick thoughts and feelings about that. So if you want to know all of that plus more, like, comment, subscribe, help the channel get to 4K subscribers, and we can get the world of investing out to more people. Follow on Instagram at Infinite Investors, also on Twitter as well. And listen, if you are new to investing, you've never invested into the stock market, my referral link is below. I'm using a free trade application, freetrade.io/infant-investors. Join below, deposit £1, and you'll be able to get a free share worth up to £200. But better than that, I think that investing into the stock market is probably one of the best decisions you'll ever make. And also, as the famous quote says, the best time to invest was yesterday. The second best time to invest is today, although it's Saturday, so you can't invest today. But you know what? You can wait till Monday and invest then. Listen, I've had a great week in the market this week, as you can basically see from this graph. It's just basically, it's had its ups and downs, but the overall market trend has been upwards this week, which has been great to hear. I did do an Instagram post saying that I broke through the 4K mark earlier on this week, and towards the end, I'm now closer to 5K than I am to 4K. So yeah, I'm chuffed a bit to the progression of the portfolio this week. Has been a great week in the market, and I'm going to give a little bit of a reason why. The first stock I'm going to talk about is Shopify. Shopify released their earnings this week, and they had a phenomenal earnings. So for the fourth quarter, Shopify reported earnings of 43 cents per share, exceeding consensus estimates of 24 cents per share. Revenue jumped 47% year over year to 505.2 million, which was higher than analysts estimated 482.1 million. Shopify's 2020 full-year outlook topped analyst expectations for the year. Shopify said that it expects revenue to range from 2.13 billion to 2.16 billion, compared with consensus estimates of 2.11 billion. So just to basically summarize all of that, revenue jumped, earnings jumped, and their guidance for the end of the year is higher than analyst expectations. So because of that, you can see there was an 8.04 increase from a percentage standpoint this week within Shopify. So Shopify had an amazing performance. It's a stock that I've only ever purchased once, as you can see here, down in the 28th of October. And, as you can see, it's 59.87% up, £605. This week was obviously a great week for that. The second stock that I'm going to talk about is AMD. For those that don't know AMD, it stands for Advanced Micro Dev. No, it stands for Always Making Dough. I've renamed AMD. Just like Microsoft is now Micro Hard, AMD is Always Making Dough, because listen, this company at the moment, I think, is probably one of the best run companies. I really trust the CEO, the products that they're making, the partnerships that they're doing. And one of the reasons why AMD Always Making Dough went up this week is because analysts actually upped their expectation of their share price target. So what typically happens in the market is that you'll have different investment banks, whether it's RBC, Barclays, or a whole bunch of other investment banks across the world, and they will follow particular stocks, particular sectors that they're interested in. And people then start to value their expectations because they're the ones tracking that stock for years after years after years. Now, RBC Capital Markets is one of the banks that follows AMD, among many other, and they've basically said that we believed AMD would hit $63 as a share price by the end of this year. And this week, they basically changed that to say, you know what, we were wrong, it's $66. And they've given a number of reasons why they think AMD will reach $66. So because of that, the AMD share price over the course of this week, you can see 9.65% up as well. I'm going to leave another article in the description. I'm not going to read any of the information from the article because there's a lot to get in there and there's a lot to cover today. But basically, it's from Forbes, and it questions whether AMD can reach the $10 billion revenue mark by 2021. one, it lists all of their different products, all of their different services, and some of the different things that they're doing and they're working on, and how well some of those businesses are growing. I think it's a great read, especially if you are invested into AMD, but also if it's something you might be interested in, it's something to definitely have a look at. And it's one of the reasons I think as well, this article came out on February the 13th, so this came out this week. So it's one of the reasons why I think that a lot of people are really bullish on always making dough, and hopefully it will continue to always make dough right through into 2021, at that point where I probably might sell. Who knows? We'll see what happens at that point. Anyway, the next stock that's been doing well this week, we're going to move over to the UK side of things, is Barratt. Listen, I've said on numerous occasions that I think Barratt is probably my favourite British stock that I've invested in. This week has gone up 5.68%. And one of the reasons why Barratt has gone up 5.68% is that there was an article released this week, and it basically said the house builder said that between the 1st of January and the 2nd of February this year, the number of sales per site per week rose from 0.74 to 0.83. So they're doing more sales on a per site basis, on a per week basis. It's also putting it on track to hit its target to grow house completions by 3 to 5% in 2020. So Barratt was one of the best performing stocks for last year for me. You can see by looking at that graph, you can see on the max indicator, how well Barratt has been doing, recently. And it hopefully will continue to rise this year if it hits its fundamentals, if it hits its sales, if it hits its orders, if it hits its revenue, then the stock will continue to rise. It will continue to pay a great dividend, and it will continue to probably be one of my favourite UK stocks. The next stock to talk about is another house builder stock that I hold, Taylor Wimpey. There was a time when I was thinking, do I hold too many? Am I too exposed? I'm more than happy to hold both of these two businesses because I just believe both of these two businesses are really well run. One thing that's interesting from Taylor Wimpey this week is that they talked about their plan to create 413 new homes. Are they going to be doing it in Staffordshire? No. Are they going to be doing it in Shropshire? No. Are they going to be doing it in Manchester? No, they're going to be doing it in Mallorca. So Taylor Wimpey Spain is set to launch 7 new developments involving construction of a total of 430 homes and an investment of 92 million. The areas in which the company plans to expand are Mallorca, where it will launch a total of 3 developments, followed by Costa Blanca and the Costa del Sol, with 2 in each. So Taylor Wimpey Spain, they're going Oca Loca, Española, whatever. They're doing their thing. Hola, they're doing their thing across the waters up in Spain. And, that just seems to be having a potential good impact. Now, obviously, sometimes when businesses are, in different territorial areas, there is obviously a lot of other factors they need to be, looking at. Like the economic climate in Spain is obviously very different to the economic climate in the UK. But, I believe they've probably done their research. They probably think this is a great investment opportunity, not just for this year, but, over the next 2 to 3 years, particularly probably with the Brexit situation. They're probably thinking, we're not going to fully expose into the UK. We need to have some more exposure into Europe, and we're going to invest into Europe. And we think Spain and Mallorca is one of the places to do that. So I believe they've probably done their thinking. I'm going to read a bit more into it, but it's obviously had a good impact on the share price this week, or I believe it's probably had a good impact on the share price this week. So those are my top movers for this week. Overall, most of my stocks were in the green this week, but obviously I can't talk about every single one of them. So let's get into the top fallers. The first top faller is Uber. Uber fell 1.33% for me this week. And you know what? There's no news about why Uber has fallen this week. So I think it's just a natural slight correction, because as you can see over the last month, Uber's gone up significantly. So, you can see this kind of funny shape here is the same shape as this bit here. So this bit, just there. So for me personally, it's nothing to even sniff at or to look at. A 1.33% drop in the climate where it's gone up 15.07% over the last month, and there's no breaking news about anything to do with Uber. The only news I found about Uber this week was quite simply the fact that you had one individual using Uber to go to Lewisham Hospital because they had the coronavirus, and they didn't follow the whole you need to isolate yourself, be in your own personal car, or take an ambulance to get there. That's the only Uber news this week that's probably negative. Other than that, everything is actually positive. So, there's no significant news there. Also, the other two stocks that I'm going to talk about is Lloyd's. They've gone down 0.47% this week. The only thing with Lloyd's is that it's 2 weeks in a row. We talked about it going down, I think, about 0.65% last week. But similar, the only issue at that time was the 56 branch closures. There's no new information on Lloyd's this week, so I think it's probably just a continuation of that. And the last stock that's gone down this week is my JP Morgan Emerging Markets Government bond, and that's my monthly dividend payer. This went down 0.81%. And it's completely fine. I'm not worried about that. This just pays my free trade ISA bill, to be honest. This is just a bill payer for me. And I'm going to continue to invest into this because, I still like the actual bond itself. I like its holdings. And, I like the monthly dividend payment and all of the other factors that I spoke about when I actually purchased it. So, yeah, those are the top movers and top fallers within my portfolio this week. If we move over to the basic side, we're going to find out that I have received a whole bunch of free shares, as you can see, but also one dividend payment, and that's from British Land of £7.34. Listen, I spoke last week about how I think dividends is better than sex. And, dividend payments, I just like when they come through, no matter what the price is. You couldn't give me £7 on road and make me feel happy about it. But I can earn £7 in a dividend and feel happy about it because my money is going to work, creating money, and that money will go back into work and create new money. And that is the wealth generation cycle, which we talk about all over this channel and in a whole bunch of videos, and I'll put links in the descriptions if you are new to that as well. Listen, I created a video this week on my dividend stocks. I was asked by the real Nihan to create a video on my dividend stocks and give an update. And one thing that I did mention I will do is re-review all of my REITs. So as you can see in my portfolio, the only two stocks that I bought in this portfolio is Landsec and British Land. Everything else here is all basically free shares from Free Trader. So thank you to Free Trade. But all of this, the first two here is basically the only two stocks that I've basically bought. And I did a video a while back on REITs. And I spoke about how there was loads of REITs, from healthcare REITs to storage REITs, that were doing really, really well from a capital gain standpoint and from a dividend yield standpoint as well. So when Free Trade dropped their new 250 stocks, I will start reviewing the REITs again, and I might bolster this portfolio and actually have 2, 3, 4 more REITs. We'll see. What I don't want to do is basically take money away from micro hard and always making dough and put that into REITs unnecessarily. But if there is a good REIT opportunity, then I might actually do that as well. So that's probably going to be my plans over the next month or so, depending on when Free Trade launch, those bunch of new stocks. Now, one thing I did want to talk about is that when is the best time to invest? And I feel like earnings season right now is giving me a great indication that it's one of the best times to basically, start investing. It's a good indication into the health of a business. And, we've seen a lot of behavior like this. If you look at, let's go to my watch list. I think I got Tesla on my watch list. Tesla. Last year, we saw that the rise of Tesla, this point here where it actually started to just do an absolute madness, that was triggered by earnings. I've talked about that in a number of videos. When we look at Apple again, they significantly last year had a rise, and it was pretty much to do with their whole services business. So Apple reported services earning of 10.17 billion, which was an increase of 13%. So we saw that was around Q2 or Q3 of last year, and that just triggered this momentum. This is a ruler, B. This is literally a 30 centimeter ruler. This is just going straight up, and that for me is showing that when people can see that other business units within a company is doing well, and when it happens in earnings, then you can see that the stock will continue to rise, and there's some momentum from that standpoint. We know with Microhard, where's Microhard? Where are you? There you are. Microhard did the same thing, literally the exact same thing as Apple. It announced that their cloud business was doing well last year, and when it announced that their cloud business was doing well, Microhard basically went up 11.6 billion, up 36% year over year. That happened around this period here, as you can see, and it just continued to rise. So there was a time when Microhard was basically just plateauing and just saying straight, and it was basically a straight road, like nothing was happening with it. Earnings came out, and it just basically went up. Micro hard is doing well, and obviously I've just bought into that pretty recently and sitting at a modest 7.96%, but that will continue to rise. I've already had it for a week or so now, a couple of weeks. The same thing happened with Amazon. So Amazon, have I put Amazon into my watch list? Probably not, just because there's no fractional shares, and man ain't balling like that just yet to be buying $2,132 share price stocks. But the same thing did happen with Amazon when Amazon basically reported their third fiscal quarter of 2019, including revenue of 70 billion and net income of 2.1 billion and earnings per share of 4.23 billion, compared to revenue of 56.6 billion, net income of 2.9 billion and earnings per share of 5.75. In quarter three of 2018, North American sales were up 24% to 42.6 billion, while international sales also grew 18%. Listen, that happened around this period here, and you can see that from that time, it basically just decided to shoot up and continue to rise. And obviously, Amazon is one of those 1 trillion businesses. Alphabet did the exact same thing as well. Alphabet basically, once they announced some of their revenue figures during their last earnings update, not the one this year, I'm talking about historic earnings update towards the course of last year, you will see that it was around this period here, and basically it was a straight arrow up. And what this is basically telling me is that, when we talk about whether or not we're in a dot-com crash, whether or not this is a tech bubble, etc., I think there's one thing that people need to focus on. The thing about the tech bubble, the thing about the dot-com crash in 2000, etc., is, for me, there was two significant points. And I might do a separate video on this in more detail, but just to give you an overview, there's two real important factors that led to the dot-com bubble. One was the use of metrics that ignored cash flow. Basically, stocks were being valued, there was a lot of momentum, but actually these stocks weren't making money. They weren't getting revenue and they weren't getting cash flow. What you've basically seen with the earnings updates over the last period with some of the stocks that I hold, and obviously some of the stocks that I've just mentioned here, is that they're year on year, they're continuously beating in revenue, they're continuously beating in earnings, and they're actually growing. So they're growing their cash flow. And because they're growing their cash flow, it's not a similar situation to the tech bubble, the dot-com bubble, etc. of 2000 also. Now, also another factor was that there were significantly overvalued stocks. Now, I do believe some stocks here are overvalued when you think of it from a discounted cash flow basis. However, I think we're in a different time. There's a lot more money moving into the market. People are putting money into tech stocks. They think tech is probably the sector where things are going to grow the most. And also these tech stocks, like I mentioned in the first point, are actually returning a revenue and a return to shareholders. So it's not as if that revenues are going down, profits are going down, but then the share price is going up, which would be then, that is a significant overvalued. Now, it doesn't mean, or it doesn't negate the fact that there aren't stocks that are making a loss, which obviously are still returning a return to shareholders. That is still happening. But I think there's less of those situations now than there was in 2000. And right now, there's a lot more companies like the Apples, like the Alphabets, like the Googles, like the always making doughs, like the micro hards, like the Shopifys and Teslas and so forth, that are actually returning a revenue, returning a profit to shareholders, and they're reinvesting, that money and growing their businesses. So I don't think that we are in a dot-com bubble. I don't think we are in a crash 2.0. If we are going to go into a recession or to any kind of crash, it'll be to do with macroeconomic factors such as GDP, such as employment, such as interest rates, such as all of those other factors as well. But probably some of these stocks might even survive that. Who knows? We'll see what happens when that time basically comes. But, overall, I'm up £1,000, 1042, I'm up from this time last week, and I've not invested any new money. So that money that I'm up this week between this portfolio and obviously my basic portfolio as well is just purely capital gains and obviously a £7 dividend payment, but it's pretty much due to capital gains in the market. So, me personally, I've gone up from 10% last week as a return to 15.43%, I think, this week as a return. And it's all because of the stock market, man. This is the stock market. This isn't Vauxhall Market. This isn't East Street Market. This ain't Brixton Market or Surrey Street Market. This is the stock market. You know, you're not getting a pound of potatoes for, 99p. You're not getting some Ray-Ban sunglasses, like not even Ray-Bans, Ray-Bans. Like, you're not getting no fake goods. This is the market whereby you are buying, you are investing into quality stocks, quality businesses with great cash flow, hopefully, great products and services, great consumer numbers, great consumer sentiment, and hopefully an even better return for shareholders. And that's why I personally believe that the stock market is the place where everyone should be. Everyone should be investing in for the future, obviously in different ways. You don't all have to buy tech stocks. You can be investing into ETFs. You can be investing for dividends. You can be investing into UK businesses, whatever suits your investment style and strategy. But overall, I think, the stock market is a great place to be. And I think this week is one of the weeks that basically highlight that. Listen, I'm going to end the video there. Hopefully you found the video informational, and listen, get into the comments if you've got any questions about anything that I've spoken about. Links will also be in the description. Like, comment, subscribe, and I will catch you next time with another investment video. Take care. Peace.